Welcome, and thank you so much for being here today. I am so glad that you came. While we're all settling in, type in the chat where you are tuning in from. I know there's a bit of a delay between the chat, but I will be reading all of your comments. And in the meantime, I also want to share with you something special. Today is the launch of my new book, The Busy Professional's Passive Apartment Investing Guide. But let me post the link in here while it's coming out. There you go. Oh, I see Dallas. Dallas is on. Thank you, Vivek. So glad to see you. So glad to see you. So I posted the link in the chat so everyone has that. And without further ado, thank you, Vivek. Really appreciate your kind words. So today is really the day to celebrate the launch of the book. And as of this morning, it's live on Amazon and paperback, hardcover, audio, and digital. But we'll get to that in a moment. I did post the link in the chat. First, I want to acknowledge the moment that we are in. And so today is not only about the book, but beyond that, and a lot of the lessons that I've been sharing over the past couple of weeks, and a lot of the lessons that I think are important to share today. So, for about 3 years, the multifamily market felt like a great Gatsby party. Capital was abundant, deals were closing weekly, sponsors were celebrated, masterminds were feeling, IRRs were hitting, champagne glasses were full, the orchestra was loud, the lights were on. And then one day, the music stopped. Oh, I see we have Bulgaria here. Bulgaria in the house. Thank you. So one day the music stopped. Floating rates moved, cap rates expanded, rent growth flattened, capital markets tightened, refinances stalled. Deals that had been celebrated 18 months earlier were now navigating capital calls or defaults. The party did not end gradually. It ended on a specific Tuesday in mid 2022, and that never came back. And most of us are still sorting through what the party looked in hindsight and what really comes next. So, this is the moment that actually produced the book, that inspired the book, and what we're actually celebrating today. So, here's the game plan for today and what we'll do within the next hour or so. I will share the story behind the book, why I wrote it, what did it really take to get here. Then we'll look at the book itself, the framework, the structure, how it works in practice, so you get a sneak peek into it. I will walk you through a real deal scenario and show you how the framework would evaluate it in real time. So we'll do that together. Then we'll play a little game. I have a little game for you, interactive one, so stay tuned. And I have a few questions for you. So your job would be to vote and tell me what you think. Oh, thank you, Victoria. Appreciate you ordering it already. And then I'll open the floor for questions. This is really about giving back and really doing my best to add as much value as possible beyond the book. So we have open floor Q&A. And those who know me and who have been at my investor parties and live events really well, that I will not leave the party until all of your questions are answered. And I know some of you messaged ahead of time that they're not able to join the live, but submitted a few questions. So we'll definitely make sure to cover those, and everyone can benefit from those when they listen to the recording of the event. And then in the end, I will walk through a few launch bonuses for everyone who buys the book. I will share that towards the end. So 2 quick logistics, like I mentioned, The Amazon link is already in the chat. I encourage you to grab it and buy the book today while we're still here together. Every purchase counts. Oh, thank you, James. Thank you, Techie Parent. Appreciate you joining. So every purchase counts, and your support truly makes a difference in helping the book reach the readers who really need it. Those bonuses will run through the launch week. So July 17th is when they expire, and you do not want to miss those. So to claim them, simply send me a proof of purchase via DM, email, text after you buy, and then I'll be sharing the details at the end of the live. Again, appreciate all of you who already secured their copy of the new book. Now the chat is open throughout, so as questions come in, drop them in the chat. I will be checking periodically and making sure all of your questions are addressed. So I'll weave them into the live as we move along, as well as a dedicated Q&A segment that we have coming up. So before we move on, one last thing. Some people asked, so this is actually the second edition of the book that I have written. The first edition came before the cycle, and this one is after the cycle. So they're really not the same book, because the first edition was published when most of us were still optimistic about the market, about what the next few years would look like. We were wrong in many of those assumptions, and the cycle gave us very valuable lessons, and those valuable lessons did not exist in the first edition. So the second edition incorporates everything that the cycle taught us, or at least my perspective on it, updated data, updated charts, and the lessons that were not on my radar, at least not all of them were on my radar 3 years ago. So sharper questions for really what comes next. And I really wrote it for the investor that I want every passive multifamily investor to become, and really even beyond multifamily: disciplined, skeptical without being cynical, patient, capable of recognizing patterns before those patterns become losses. And that investor is you, all of you who are joining live, all of you who already secured a copy or are about to secure their copy, or someone you know or someone you are becoming. So I'm really grateful for you, really happy and grateful for this. So without further ado, let's begin. So before we get into the book itself, I want to share 3 short stories, and each one connects to why I wrote this book, and why does it exist in the form that is in the form that it does. Oh, thank you, Milena. Thank you so much for joining and the kind words. So first story, it's about how I learned to evaluate deals. And most people learn underwriting from the buy side. They learn to find the deal, model the returns, raise the capital. And I've gone through all that process myself, but where I started or where I came in was a slightly different direction. I spent years in commercial lending, underwriting, risk management, where my job was to evaluate deals from a lender's perspective. And the lender's question is different from that of the buyer. The buyer would ask, what can this deal become? What is the upside? The lender asks, what could break this deal? And how confident am I that it will not? How do I lose money on this deal? And those 2 questions produce very different ways of looking at the exact same property. Lending taught me to read the deal structure rather than its story. The story is what's on the offering deck, or as people know it, the pitch deck. The structure is what's really in the loan documents, the offering memorandum, the financials, the capital stack. The story is what sells the deal. The structure determines whether that deal survives. And so this book is built really on the lender's question in terms of how do I protect the downside? How do I protect my principal? Every chapter, every framework, every diligence question, the underlying lens is what could break this deal, and how would I know? How do I lose money on this deal? Why should I not do this deal? And that's the lens I want every passive investor to have, because saying yes, right, and going for the high level marketing information, that's the easy part, but that's not what protects the deal. Now, the second story is one that I learned the hard way. I've been an investor for many, many years. And so several years ago, I was involved in a deal that did not go to plan. I will not name specifics because that's not the point of my message, to point fingers at people. Really, what I want to emphasize is the pattern. The deal looked good on paper, location was strong, the sponsor had the track record, the model showed reasonable returns. I asked the questions that I knew to ask, and I did the diligence that I knew to do at that time. What I did not do was push hard enough on a few specific assumptions, as well as really go deeper behind the sponsor's track record. And in retrospects, those assumptions, those items really mattered the most. I trusted someone with the answers, and I should have challenged some of those or pressed on those. And I accepted the sponsor's framing on a few points where I really should have asked for the underlying documentation. And the deal did not fail catastrophically, but it did not deliver what the original model suggested. And the lesson I took from it was more valuable than any lesson I could have learned from a deal that actually performed. Sometimes those painful seminars, as I like to call them, are the ones we learn the most from. And so every chapter in this book is a version where I had to learn the hard way. So I'm sharing with you some of my hard lessons learned, with the hope that you will not have to go through some of these experiences. And the book is not theory, it's actually the lessons from someone who has been in the seat, who's made the decisions, who's lived with the outcomes and refined the framework over time. This is what makes the framework durable, and it has been tested under multiple conditions and market cycles. And then the third story is about why this second edition rather than a brand new book. So the first edition, as I mentioned at the beginning of the event, came out before the cycle. The framework in those pages was conservative underwriting, adequate reserves, prudent leverage, careful sponsor vetting. These principles are not new, and they have not changed. However, in my humble view, many of those were underapplied during the boom. And so the cycle tested every one of them. Conservative underwriting was punished in the bidding wars. Adequate reserves dropped IRR comparisons below competing offers. Prudent leverage meant that losing deals to sponsors using bridge debt. Careful sponsor vetting meant saying no to deals that other LPs were saying yes to out of fear of missing out. And then the cycle turned. The sponsors who had been disciplined were the ones whose deals survived. And the investors who said no were the ones whose capital was protected. The principles held, they just held in a different sequence than anyone expected. And so the second edition incorporates what this cycle taught us. Some chapters got updated and sharpened, some got entirely rewritten. Some chapters did not exist in the first edition because, again, the situations that they cover did not exist in the same way 3 years ago. Pause distribution as a diagnostic, the capital stack that closes with very thin coverage, the first post-cycle deals as the sponsor's clean test. And so a lot of these frameworks are the same, but the questions are deeper and the data is more current. So it's really this book that I would have wanted to have before and during the cycle. And it is the book I want every passive investor to have for what comes next. With that, let us look at the book itself. Oh, thank you, BG Prog. Really, really appreciate you. So let me show you what's in it, and then I want to walk you through how it works in practice. So this is a copy of the book. Not sure if it's coming across fine. Yeah, there it is, kind of, sort of. There it is, at least part of it. So hopefully you can see it. The book is structured in 7 parts and 44 chapters, really 43 chapters plus an appendix, which is actually quite detailed and has a few more points and resources. And so each chapter stands on its own as a reference, but they build on each other as you read in order. Part 1 covers the passive investing fundamentals, what syndications are, how they work, who the players are, sharing not only the benefits but also the risks. Part 2 covers the market selections, how to evaluate markets, sub-markets before you even look at a specific deal. Part 3 covers the deal evaluations, the key assumptions, how to read a pro forma, how to spot assumptions that are doing maybe too much work. And then part 4 covers operator vetting. This is the part I want every passive investor to read most carefully, because the cycle proved that sponsor selection is the single biggest factor in passive investing outcomes. I know this is a hot take. I know many will perhaps disagree with this statement, but that's usually that's my humble view, and to this date, I think that's usually every deal vetting process should start from. Part 5 covers structures, fees, waterfalls, how the legal entity works, how money flows, how fees actually affect returns. In part 6, I dive into tax implications, what the K1s mean, how passive losses work, what to expect from your CPA. Again, sharing many points that are not widely discussed, or perhaps maybe brushed over on social media, that are important to know. And then part 7 covers ongoing investment management, how to read the monthly and quarterly reports, how to respond to capital calls, how to evaluate pause distributions, how to know whether a deal is recoverable versus terminal. And it is the resource that I wish I had when I first started investing in apartments and syndications. So I do want to walk through the framework and how it works in practice. Oh, thank you, Sunit. Appreciate you chiming in, and I'll definitely make sure to cover your questions. So thanks for dropping that in the chat. And just a reminder for everyone, feel free to drop your questions in the chat. I will cover each and every one of those during the live Q&A, which is coming up in just a few moments. So I do want to walk you through a real deal scenario. Now, a lot of the deal identifiers have been changed to protect the innocent. And again, my point with these examples is not to necessarily point fingers. It's rather to extract the lessons learned and also show you how things work in practice. So imagine that you're a passive investor, you're receiving an offering for a 200-unit value-add apartment community in the Southeast. The pitch deck shows the property is currently averaging 1,700 unit in rent. The sponsor projects bringing rents up modestly through a light renovation program and operating improvements. The pro forma projects an 18% IRR, 18 to 20 IRR over a 5-year hold with potential refinance in year 3. 2 more details. The sponsor is relatively new partnership. They've done deals, but this is their first acquisition in this particular market. They do not have the boots on the ground presence in the submarket, and they plan to manage through a third-party property manager. So the offering looks reasonable, the number is pencil, the deck is professionally done. The question is, what do you do next? And this is where the framework starts and what the book dives into. The first discipline is market selection after you've vetted the sponsor. You ask, is this submarket actually a market where this rent level holds? It's the time to at least request comparables from the sponsor or pull those yourself if you're actively and if you're the one managing the deal. You look at recent leases, not just the asking rents. You look at the concessions. You compare the property's rent to the actual market rents. And here's where the first thing breaks in this particular example. So the property reports 1700 per unit projected, but the actual rent in a lot of nearby comparables is 1400. So the headline rent on the marketing material includes concessions, special offers, units that perhaps signed at the top of the year prior to the market softening. And so the real economic rent is meaningfully below what the advertised rent is. And so if you stop here, you already know that this deal is not what the deck describes it to be. The second part is the deal evaluation itself. And so that's where you ask, well, even if I accepted that 1700 number, what does the deal look like at the rent the sponsor is actually achieving, the 1400? And so the IRR projections would inevitably fall in that scenario. The refinance maybe doesn't happen at all. It gets much shakier. And then the cash flow projection overall looks very different. And I did keep bringing up the operator, but this is the part that really matters most given the specifics of the deal. So in this particular case, the sponsor being new to the market, haven't done a deal there before, relatively new group. They do not have boots on the ground, and their plan is to entirely rely on the property manager, which it's not uncommon to hire property managers, but to entirely rely on them just because they don't have presence in the market creates another layer of risk. And so each of these elements by itself is not necessarily disqualifying, but when you put them all together, they describe a sponsor whose operational visibility into that specific property is most likely limited. And unfortunately, when rent surprises become visible to them, they will be hearing it from the property manager and hearing it after the deal closes rather than seeing it themselves ahead of time. And so the lag between the problem and the response is usually longer than where it should be. And the fourth discipline is really the structural analysis. So not only the numbers of the deal, but the structure of the deal. And that's going through the private placement memorandum, PPM, all the other legal documents. If you're on the active side of and managing the property, going through all the loan documents, reading the credit agreement, security agreement, promissory notes, all of that in detail. So you look at the debt structure, you look at the fees, the reserves, the capital stack. And so many people will stop here, and I will probably stop here for time because I can dive into this deal deeper. But you can see how this is going. By the time you have walked through all these elements, the sponsor, the market, the deal numbers, the deal structure, you have a clear picture of whether this deal earns your capital or not. And so the deal I just described, for the reasons I shared, would not earn it. Again, not because any single fact is necessarily fatal, right? But because the combination of these facts would produce a clear picture of a deal where the rent assumptions do not hold, the sponsor's operational visibility is limited, and the structure has not been stress tested against the realities of the market. And so this book walks through each of these five disciplines in greater detail, and each one has chapters, examples, questions to ask. It also comes with a ton of resources, complementary resources inside the book. And then the framework I just walked through in roughly maybe a few minutes lives across more than 250 pages of practical and then applicable material. And so if you take one thing away, take this: every deal you evaluate deserves a framework, repeatable framework that you can apply over time, not just the deals that smell wrong on the first read, but the deals that look reasonable are actually the ones where the framework matters most. And reminds me of a saying that calmer waters are the most dangerous waters, and that's where you should pay most attention to. The reasonable looking deal is where investors typically get hurt because the diligence felt unnecessary, especially if you only look through the headlines. Now, let's have a little fun. I have a few quick scenarios for you. Your job is to vote. You can put your answers in the chat. I'll give it a minute because there seems to be a bit of a lag with some of the posting of the comments. But your job is to vote, and then we'll walk through the answers, the frameworks, and why they are the way they are. So I'll give you a couple of scenarios. First one is a sponsor is pitching a deal. It's a first come, first serve allocation. The deal offering documents, the PPM is about 100 pages to 100, 150 pages. They want a commitment within 72 hours. What do? Option one, you commit. The deal is hot for a reason. Ask for 7 days to review is option two. And option three is decline. So I'll give you a moment to type your answers in the chat. Okay, so option one is you commit to the deal because they only gave you 72 hours. You ask for 7 days to actually dive deeper and review. And option three is decline. We'll give it another minute. All right. I love the answers. Ask for 7 days or decline. So yes, I really appreciate you guys sharing that, because that's the moment to take a step back and pause. Oh, thank you. Yeah, thank you, Christina, Vivek, Gary. Appreciate you. So yes, the book covers actually exactly that in the chapter on the fear of missing out trap, which, by the way, is not isolated to any market, really. And so the right answer is rarely to commit. Sometimes it's decline. Often is to ask for those additional 7 days, as some of you already noted. And so if the sponsor cannot give you 7 days, that itself is a piece of information and a single. And then Vivek notes 7 days may not be enough to do research. So absolutely, yes. After you review the initial information, depending on the questions you have, that may not even be enough. So spot on. So you may have to ask for more. I just had 7 for the examples. Or if you don't feel like you have the time to dedicate to properly diligence the deal, then the other option is to simply decline and walk away. Now I'll give you scenario number 2. A deal that you're in pauses distributions. The sponsor communications so far have been vague. What is the first question that you ask? When will distributions resume? What does the trailing 12-month financial package show, and what do the projections show? What is the lender saying? So what is the first question you ask when you are served with this pause distribution notice? When will distributions resume? What do the financials and projections show? What is the lender saying? So I'll give you a moment until the answers flow through. And these are, by the way, real scenarios. I speak with And some of the services I offer are second set of eyes on deals. So by virtue of that, I see a ton of deals. I talk to a lot of investors, and that's not a hypothetical scenario. It happens more often than maybe you realize. So I see financials. Yes, I love it. Love it. So absolutely. What is the lender saying? Then check the financials. Yes, all great responses. And actually, the book covers this in a more detail in part 7 on monitoring your investments. And so definitely studying the financial package is the right question to ask. Understanding if a refi is involved, what the lender will say. The when will distributions resume question really gets you the sponsor's narrative, but the numbers diving into the detail really gets you the underlying truth. So definitely read the package and then form your own view and ask the question that financial package raises. So oh, great point. So financial is what's in my mind, but I'm not sure if the sponsor or the CPA will share it with 506B investors. Very important question, Vivek. So I really appreciate you bringing this up. They absolutely must share. Ideally, they would have been sharing the financials so far. If they haven't, that in and of itself is a red flag. So at a minimum, historical financials should be shared. Also, the projections. If they are declining to share, that's definitely a red flag and a big, big matter of concern. So I appreciate you asking that because it's not an option for them. It's an obligation to share that. Okay, scenario number 3. So a new sponsor with no full cycle behind them is pitching a deal in the market that you know very well. The deck is professionally done, extremely good looking. The math on the surface looks reasonable. What do you weigh in most heavily as you're trying to determine next steps? The offering memo, the math behind the numbers, or references from prior investors? So, again, you're presented with a great offering deck, numbers look good based on your initial review. What do you weigh in most heavily next? The deck, the numbers, or references from prior passive investors? So I'll give you a minute until the answers trickle in. I love it. Yes, I see answers trickling in. So references coming through, and that's extremely important. So thanks for chiming in, Vivek. Thanks for chiming in, Gary, Christina. Absolutely, you're spot on. And the book goes into more detail in part 4 under the operator vetting structure and framework. And the right answer is references from prior passive investors, and ideally references from investors the sponsor did not introduce to you. And some may argue, well, how do I find them? I actually discuss exactly that in the book. And of course, the offering memo is the easy single. The math is, you would probably know it if you're actively evaluating deal, and it's black and white, right? Easy to model. But references from prior LPs, especially the ones that the sponsor did not select, are really the hardest signal to fake. That's where you get the real truth on how the sponsor is behaving and are they really walking the talk. Thank you, Neil. Yes, absolutely, references. So I love it, love it. So scenario 4 is bridge debt maturity. So you're looking at a deal with bridge debt maturity. Let's just say matures in 2027. The sponsor projects refinancing into agency debt. And so what do you ask first? What rate do you assume on the refi? What happens if the refinance does not happen on schedule? Or 3, what is the rate cap structure? So again, you're evaluating a bridge debt deal with bridge debt that matures in 27. Sponsor is telling you they're refinancing into agency. What question do you ask first? Number 1, the rate that is assumed. For the refinance, what happens if the refinance does not happen on schedule, and what is the rate cap structure. So I'll give you a minute until the responses trickle in. And we saw, by the way, quite a few of those deals between 21, 22, even some in 2023. A lot of them are now coming due. Many are at their second and third extension. So again, it's happening in the market as we speak. So I see the responses coming through. The rate cap structure, seeing some issues today. Absolutely. What will happen if the refinance does not happen? Very important to know. What happens if it doesn't happen? Yes, absolutely. And so all three are actually good questions, and the book would suggest that the second one, what happens if the refinance falls through, is the most diagnostic. Yes, many of you are saying I'll ask all three and all of the above, and that's actually, I would agree with that, because so the rate cap question matters, the refinance rate matters, and what happens if it doesn't fall through matters, because it tells you if the sponsor has a plan B, right? What if that doesn't walk through? Are we looking at a capital call? Is the deal getting foreclosed on? What's happening if that doesn't pan through? And sponsors with that real plan B will answer with very specific. Sponsors without one will likely be generic, maybe give you reassurances, but you really want to dive into the details. Regarding the rate cap, yes, there are a lot of issues with those today, and especially in cases where the deals were not fully hedged. Sometimes sponsors took shorter rate caps, not for the full loan tenor, or caps that cover not the full loan notional amount. Maybe they only cover part of it. And so a lot of them are have been, not only are, have been dealing with that situation. And so I'll give you one more scenario, because I do want to move along, and I did promise you to address all the questions. So it's a capital call, and that's happening a lot in the current market. So I think it's a relevant example. So let's just say you receive a capital call on a deal you're in, and for avoidance of doubt, I'm referring to capital calls in single asset deals and syndications, right? For just one small distinction, a capital call and fund structures, those are ongoing and then just part of how funds work. So this is specific to a single asset syndication deal. So the sponsor is asking you to wire 20% of your original commitment. What's the first thing you do? You wire the funds to protect your investment. You ask the financial details behind the capital call, or three, you decline and you accept the dilution that comes with it, or even penalties if there are such. So what's the first thing you do when you receive that capital call? You wire the funds to protect your investment, you ask for the financial detail behind the capital call, or you decline and accept the dilution and move on. So I'll give you a minute to uh, uh, share your answers in the chat. But again, these have been happening for the past couple of years, and unfortunately are continuing, because we haven't really seen the full amount of distress unraveled. What are the funds being used for? Financial details. Ask for financials. Financials, absolutely. And protection of the funds, absolutely. Some capital calls may be okay. These are all great responses. So definitely the right answer is to ask for the financials. And the book actually goes into very detail. It gives you step by step process how to evaluate the capital call, what questions to ask. And yes, Cash, you're absolutely right. Sometimes capital calls are the right move, and sometimes they're the wrong move. So without asking those questions and without diving into the financials, the projections, you wouldn't know which one it is. So only wire the money after you have seen the package, after you understand why the capital call is the right path for this specific deal at this specific moment. Almost evaluate it as a brand new investment, because you're essentially putting in fresh money, even though it's an existing deal. So So beautiful. Now, I do want to share with you some of what the early readers are saying about the book, and this is where I really want to pause and thank my launch team. You know who you are, and these are investors who raised their hand to join the early launch team, share their early impressions, and shape the book. So I really appreciate you, your support, and the time. The book has now been live for a few hours, but the early readers from my launch team have been with it for a couple of weeks. And so I do want to share a few of their reactions, why they stayed with me. And I want to share them with you because they tell you more about the book than what I can share in my own words. Oh, thank you, Cash. Yes, absolutely. So I wish I had a guide like this when I first started investing. And I actually felt like that very much even after I completed the book, because again, it covers a lot of not only the basics and the fundamentals, but also it presents a more balanced view of the lessons learned and from the last cycle. Just finished reading your book, and I got to say it was very informative, enjoyed reading it, and I also learned a lot. It will definitely add value to people who will get a copy of it. And that was really the goal, is to one of my missions is to create educated and empowered investors, and the work I do in terms of the content that I publish is how I accomplish this mission. So glad to hear that it added value. What stood out most to me is that the framework remains disciplined, grounded, rather than overly promotional. The emphasis on underwriting awareness, sponsor quality, risk visibility, and long horizon thinking creates a much more serious and institutional discussion around passive investing. And for those who have been following me for a while, you know you won't get fluff, and you yes, you'll get the positives, but also the downside, and it presents a more balanced view. Again, a lot of the voice in the book and how I think about investments is shaped by my years in risk management and underwriting. And so I definitely wanted to bring that forward in writing the book. Um, I must say I'm extremely impressed with the materials and knowledge you're sharing. I really like the flow of the book and how each chapter is not too long and can be easily digested. And absolutely, each chapter is designed to stand on its own. It's really designed, the book is designed to be a tool that you can use in your passive investing journey. It's written in plain English. So whether that's the first time you're thinking about investing, or maybe not the first time, but you're looking to sharpen the lens and go deeper, it definitely shares that in a lot more detail. And so I really again appreciate the launch team readers who took the time to read the book, share their early impressions. And also thank you for all of you who already bought the book. I see the messages flowing through the chat. So I do want to open the floor to your questions. I also received a couple pre-submitted ones, but I will go through the chat first. So I remember Sunit asked the question. So how do you know if the market is favorable or not at the time of a deal so that you get maximum tailwind? Oh, this is a very important question. So I appreciate you asking, Sunit. Well, there are a few points. Beyond the market fundamentals, right, like population growth, job diversity, and following all these trends, because effectively they tell you, are paying clients, meaning tenants, moving to your market, right? If population is moving, if new households are being formed, if jobs are there, that's the first signal. Now, what we learned in the last cycle is that a lot of markets with who had those strong underlying fundamentals still underperformed, unfortunately. And that came to one big factor, namely the supply and demand. So it's extremely important to understand the not only the demand factor, which is what the job growth, population growth, household formation tells you, but also the the underlying supply. And so markets that have historically been strong, like Phoenix, Dallas, just to name a few, they're not the only ones, um, who have very strong underlying fundamentals, have been struggling in the past couple of years, namely due to that big supply wave that came into the market. And then one other factor also to test is the affordability, because you may have all these underlying fundamentals when evaluating a market, but if the client or the tenant is tapped out in terms of median household income, it doesn't matter. It doesn't matter what your projections show, right? It's ultimately what they can afford to pay. And so it's important to factor that into consideration. If it's not factored in, that's where the economic vacancy starts creeping in terms of maybe concessions, vacancies, or even worse, delinquencies. And we're actually seeing that in many markets, especially with Class C property. Many of you may have been reading about the K-shaped economy, where the lower 10%, 10 to 20% of income earners are really, really struggling today. And that's definitely, I'm seeing it in deals real time. So very important question, and I appreciate you asking it, Sunit. So a couple more that came through. Let me just click through the chat. Okay, so I see one right here. The question I'm asked most often is what the single biggest mistake passive investors are making right now. I guess it's coming through in the conversations. And so my answer is that many of them are still comparing deals on projected returns. And I'm not here to say that projected returns or returns do not matter, but many of them are making decisions based on projected returns rather than the durability of the deal. And then this cycle in particular proved that the highest projected IRR is almost never the deal with the best actual outcome. The deals that survived had lower IRRs on paper and higher actual performance. And again, I really want you to think through this. A lot of times I hear the framing high risk, high return, and I have a problem with that statement. Why? Because it almost implies that the return that comes with this higher risk deal is guaranteed, and that's not at all the case. If anything, higher return, or the way I think about it from a risk perspective, is that higher return basically means higher probability for loss. So that's the framing I would like to encourage you to think through and really peel the onion to understand, are these returns that look appealing on paper, achievable and realistic? Oh, thank you, Sunit. Yes, I'm happy that the response was helpful. Now, if you're newer to passive investing and just bought the book or purchased the book, the question of where to start really matters. And it really depends on where you are and how much you've done in terms of investing. So if you are evaluating a specific deal, I would say maybe start with part 3 and part 4 of the book. They really go into detail in terms of how to evaluate a sponsor, how to evaluate a deal. If you haven't yet committed to anything, maybe you don't have a live deal on the table, start with chapters 1, 2, and 4th. And if you're already invested and maybe managing through capital calls, distributions, and such, I would lean towards part 7. And so, again, the chapters build on each other, but they're written in a way that allows them to stand on their own. So you can come in and out of any chapter as questions come up and as you need them. Oh, I love this question. How is this book different from Mastering Multifamily Underwriting? Well, Mastering Multifamily Underwriting is very specific on the topic of underwriting. It's a technical underwriting book written in plain English for the beginner investor, but it really walks through how to do the math how to go through the numbers in detail. This book is actually broader in scope because it covers the full process of passive investing and diligence, reviewing the offering documents, the sponsors, managing your investment, different ways to invest in syndication. So they're really designed to complement each other. So if you're looking to do a deeper dive into the deal analysis, the underwriting, I would say Mastering Multifamily Underwriting is a great fit. But if you're looking for that broader perspective and really understanding the holistic process of evaluating a deal, not just the numbers, then the passive apartment investing book would be the appropriate one. How do you decide which deals to commit to in your own portfolio right now? Well, great question. Well, my current approach has always been conservative. In fact, someone commented the other day, "You're one of the most conservative investors I've seen." I don't know if that they meant it as a compliment or not, but I do look at fewer deals, meaning deal flow hasn't really slowed down for me, but I'm definitely being more selective in terms of how I deploy capital. Definitely going deeper into the sponsor track record. I ask a lot more questions than I used to ask a few years ago. I weigh in the reserves very heavily, stress test the deal. And when I go through my process, very often the IRR lands lower than what the deck shows. And then the question for me, right, as an investor is, does it make sense for me to deploy capital at that projected level of return that I view as being the baseline return? And so I had to walk away from a lot of deals. I love doing deals, but so saying no is not easy, but it's important to do so. So to answer your question, still very much active in the market, but on a very selective basis. What would be the top challenges when pivoting from active investor to passive investor? I really appreciate you sharing that because, or asking that question, Cash, because there are definitely subtle differences, right? As a passive investor, you still have to do your due diligence. You're not the one necessarily sourcing the deal, calling brokers, negotiating the lending, but it doesn't mean that you shouldn't spend time upfront to do deep diligence on the deal and the sponsor. So while the due diligence aspect may not be as involved, right? You're not doing the phantom calls, walking properties, and whatnot, negotiating with brokers. It's still important to evaluate the sponsor, their track record, evaluate the deal markets, form your own view of the market, and then and the deal and the structure, and then evaluate, does this align with my investment thesis? Now, the second biggest factor, and that's why syndications may not be a right fit for everyone, is the fact that you are passive, meaning you do not control the day-to-day operations of the property. So if you're not comfortable with giving up that control, then I would say don't do syndications, because you're going to fret over the 5 or 7 year due horizon and feel helpless and you cannot make decisions or influence the deal. And so being comfortable with no control, which is why the sponsor factor here is extremely important. How they communicate frequently, openly, transparently. What's the quality of the information they share? Do they send you a couple of pictures with the monthly update, or do they give you the detailed financial reports with these monthly or quarterly updates and really walk you through the underlying trends, communicating with you proactively versus reactively in terms of the challenges that the deal is facing? Every deal has challenges. In my career, both as a lender and investor, I mean, I'm having a hard time remembering a deal that went absolutely smoothly with zero issues in between. So challenges are just inherent part of any business. So how you communicate and how you work through those is extremely important. So I would say definitely the due diligence. Don't let go of it, even though you're joining passively. So don't completely rely on the sponsor, but challenge their assumptions. Go into the documents. That's again one of the learning experiences I shared at the beginning of the call. And then the second part is decide if you're comfortable with lack of control. And if you are, that's where you really have to dig deeper into the team's track record and performance. So I really, really appreciate you asking that. I see a question on capital calls. How do you decide whether to participate in a capital call? Well, I would say start with the financial package, right? The book covers actually the whole diagnostic process in part 7. And so the question is not whether the sponsor is asking for capital, it's whether the deal at this particular moment earns the capital and has a real path to recovery. Some deals do, and there may be, like I said earlier in the call, a good reason to do a capital call. They're all not bad, but the financial detail is really what will tell you which position you're in and whether to go or pause. And sometimes the best answer is not to contribute, especially if there is no tangible path forward to save the deal. So I appreciate all of your questions. Now, I did promise to share with you the gifts and the bonus details. And so here's how to participate in today's launch and what you will get in return. I mentioned that the Amazon link is in the chat, and I will include it again so you have easy access to it. I encourage you to click on it now if you haven't already. Every purchase counts, and so today is the big day. And there are a few prizes that I have with you. So for every launch week buyer in any format, hardcover, paperback, digital, audio, you receive the launch edition bonus kit. This is a PDF that expands on the 18 cycle lessons. It's about 50 pages, so very detailed. So you will receive it within a week as I work through the different messages. Just send me a screenshot or proof of purchase so I can get your information and make sure that you receive that. Also, you will receive a private 60-minute group Q&A session I will schedule that within 30 days of launch. I will host the session, take your questions on the book or anything else related to passive investing or due diligence, and the conversation will be recorded for those who are not able to join. I understand the scheduling will not work for every single one of you, but I will make sure the recording reaches you. And last time, actually, with the first book, I offered a similar bonus, and we went almost 2 hours. So again, I will stay for for as long as the questions keep coming. Now, for the first 30 individual buyers, in addition to the bonus kit and in addition to the group Q&A, you will receive a choice of 3 options: either a 30-minute Deal Express review, where I help you evaluate a specific deal that you're looking at. Option 2 is a hand-signed copy of Mastering Multifamily Underwriting or the Passive Apartment Investing book. It's your choice. I'll ship that to you. Or if you already own both books, then I will share with you actually a 45-minute private consult. Again, this is only for the first 30 buyers of the book. For the first 10 bulk buyers who purchase 10 copies or more, in addition to the above, you will also receive a 60-minute private consult plus a hand-signed copy of either the Mastering Multifamily Underwriting or this book, again, your choice, shipped to you. So again, this is for the first 10 who buy 10 copies or more. So to claim your bonuses, simply send me a proof of purchase via text, email, DM, whichever works easiest for you. Send a screenshot of it and I will reply with the bonus kit, the schedule link, and all the details as I basically work through all the messages. Those launch incentives close on July 17th at midnight Pacific time. And after that, the book will still be available, but those additional bonuses would not. And one last thing on why today matters, and why I keep saying buy the book today. It's available on Amazon and as well as soon on other platforms. But the Amazon's algorithm weighs launch week sales really heavily, and the more sales the book reaches this week, especially today and tomorrow, the more visible it becomes to the next reader who may be looking exactly for this material and exactly for this solution. And so the visibility is what determines whether the book reaches investors who really need it. So if you have been thinking about buying, today is the day. Your purchase is valuable, and it helps the book reach many people, and help investors. And if you already bought the book, I would really appreciate you over the next few days as you read a chapter or two to leave an honest review on Amazon, 2 or 3 sentences, or even one sentence with your maybe key distinction or key distinctions. Review is how the next reader, and the one who has not heard of the book yet decides whether to look closer. So I really appreciate you for doing that. And yes, Cash, absolutely, I will be sharing the bonus guide PDF with anyone who gets the book today. And I know you already got your copy, so I really appreciate your support. And so before I wrap, I want to acknowledge a few people, and namely my launch team. You know who you are. As well as all of you who joined the live event today. I really appreciate you being here, whether you bought the book or you're still considering, whether you've been following the daily lessons I've been sharing over the past 3 weeks, or if you just discovered my work today. Your presence here is what made this launch special. I really appreciate you. Starting next week, I actually have a few more lessons to share, so I will be sharing those as we continue to move through the launch. And then I'll return to my normal posting cadence. The book will remain available. Launch bonuses that I just shared run through Friday, July 17th, but the conversation will continue in the place where it always has: your comments, your DMs, and the conversations that emerge from this work. Again, just a quick reminder on the bonuses. So for anyone who buys today, you will receive the launch edition bonus kit, which is a PDF that expands on the cycle lessons. It's about 50 or so pages. You will receive the 6-minute group Q&A, which I'll be scheduling within the next 30 days or so. For the first 30 buyers, you receive a choice of one of those three. There are 30-minute private express deal review consult, or a signed copy of either of my 2 books. Or option 3, if you already have both books, I'll just say a 45-minute consult. For the first 10 bulk buyers, in addition to all of the above, you receive a one-on-one private consult and a signed copy of the book. And simply send me a copy of your purchase, and that's how I'll make sure to share all of that with you: the PDF, the links for the calls, details, and all of the above. So I really appreciate you being part of this. I will see you in the conversations. Happy Saturday, happy launch day. Again, thank you for being here today. Thank you for sharing your thoughts, comments, questions, your thoughtful and active participation. I appreciate you, and I wish you a beautiful day. Ciao.